Okay, it looks like we've stalled out on the numbers coming in, so let's get going. Good morning, everyone, and thank you for joining our webinar on lease accounting today. This is the third in a series of webinars that we have planned related to lease accounting, kind of a repeat of what we did last year with some updates to it. We have one more planned for a little bit later in the year, so look out for that. We'll have some communications around that as we solidify the timing on it. You will see that the chat function is disabled, but the Q&A function is enabled. So if you have comments or questions, please put them into the Q&A function. And we're going to do our best to respond to all those during the webinar today, as we've done in the past. But if we don't get to them, we'll do some direct follow-up with you. Towards the end of our presentation, we will open things up for Q&A. So think about questions that you might have, and you can chat them in at any point during the presentation. And if we can get to them while we're going through the actual slides, we will. Otherwise, we'll catch them at the end. I just want to make sure you're aware of that now so you can think about some questions that you might have. Also want to let you know that this is being recorded, and the slides and a link to the recording will be sent out later today. We're also going to be offering CPE credit for today's webinar, which means that we're going to have polling questions about every 15 minutes or so, and you're going to need to answer those polling questions in order to receive CPE credit. And if you haven't been to our YouTube channel lately, I would encourage you to check that out as well. There's a lot of content there. These videos go up on there as well. So we're not going to try to help you change out that old bathroom sink that you've got, but we certainly have a bunch of videos up there relative to accounting matters that might be of assistance to you. I'm also joined today by my partner, Kevin Shives, who you've heard from on many of these webinars, and also by Joe Brunell, who's a senior manager in our audit practice. We're kind of the core of the lease accounting team here at Sensiba San Filippo. And then we've also got Jess Vento, who's the Senior Director of Accounting at LeaseCrunch, our software partner on all of this. And she's going to do a demo of the software today. And for those of you that have been on prior webinars and had questions relative to financial statements and things of that nature, she's going to run through how LeaseCrunch can really help with that, as well as on the modification side. Here's our quick commercial about SSF. So we're a full service consulting, audit and advisory firm. We've got offices in Northern California and in Oregon. We serve clients across the US. We've been in business for over 40 years. And in addition to audit and tax, our consulting group offers a whole host of services that complement that business, including the outsourced CFOs and controllers, outsourced accounting, internal audit, and a bunch of technology solutions that we work with. And we're also one of a handful of accounting firms that's B Corp certified, and that's a designation that indicates that we strive to balance purpose and profits. And you can find out more about that on our website at www.ssfllp.com. This whole concept of B Corp is really hot in the marketplace right now, and we've also got the Sensiba Center for Sustainability that you can get to through our website as well. So I encourage you to take a look at that if that's of interest to you, and we'd be happy to help you with that if you need some support there.
Yeah, thanks, Frank. Specific to SSF Consulting, as you mentioned, we provide outsourced accounting, internal audit, and SOX solutions. And we also work with a variety of technology publishers that you see on the bottom right-hand side of the screen. Accounting for leases being the focus today, of course, we will be having a demo of LeaseCrunch toward the end of today's webinar.
Thanks, Kevin. So here's our agenda for today. We're going to cover 842 again from the lessee perspective. Some of what we will discuss today was discussed on our last webinar, and as I've mentioned in past webinars, the feedback we continue to get is, hey, we need to hear this over and over again. So there will be some repetition, but we've tried to cut that down to really the most important things that we think you need to hear. We're going to focus on lease modifications today and footnote disclosure requirements. I will tell you the lease modifications were probably a little bigger hot button as we were working through more of the heat of the pandemic. Now that we're a little bit through that, I think those are going to be a little more on an exception basis and maybe not the norm, but we still want to cover what the requirements are because we think it's important to educate you relative to that. And we totally believe that a software solution is the way to go here. And I know we still have some clients coming forward that say, hey, we think we can do this in Excel. But I think once you see that demo from LeaseCrunch, you'll understand that having this encapsulated in a system where you can track it all, you can maintain your documents, Jess will do a wonderful job of giving you a high-level overview of the system. And it's very, very user-friendly. You know, once you get a couple of these leases in there, it's going to be very simple for you to figure out how to operate in that system. So highly encourage you to keep that in consideration. So in terms of effective dates, we've talked about this before. The standard was effective for public companies all the way back in January of 2019. And fortunately, they delayed it a couple of years for private companies and not-for-profits. So for those companies, it became effective January 1 of 22. So for many of you, it's already effective, but technically speaking, you don't have to do anything until year end, which is good. It gives you some time to prepare. And for not-for-profits, that may be a 6/30 year end, it just became effective on 7/1. So you still got some time to do it. Kind of what I'm seeing in our practice and in the companies we're consulting with is everyone's kind of pushing this to the later part of calendar 22. So I imagine that the fourth quarter and the first month or two of 23 are going to be quite busy with helping people get ready for all of this. And the overall goal, of course, is to get these lease liabilities onto your balance sheet. So now that we've covered the effective date, here's a high-level overview of the adoption requirements. And so think back to when we adopted RevRec. You know, you can expect a lot more disclosure in the financial statements related to this. You're going to have new accounting policies that will need to be developed and a discussion of the major assumptions and the practical expedients that are going to be employed are going to need to be disclosed. And I think when we get into the financial statement stuff a little bit later, you know, from my perspective, having been an auditor for 25 plus years before I jumped into this consulting role, I think the balance sheet and the income statement and the cash flows actually are pretty simple when you step back and take a look at this. The piece that gives me a little bit of angst is the footnote disclosure, because there's just a bunch of different things that need to go in there. And I think that's really where the software tool really comes into play and helps you quite a bit. It's going to give you the journal entries to get the balance sheet and the income statement right. And as we talk about the cash flow a little bit later, I really don't think that's going to be all that difficult. But those footnotes can be a little bit tricky. And relative to practical expedience, we've talked about this in the past. You know, if you want to, you can go to our YouTube page for a refresher on that and take a look at it. And then clients are also going to have to choose how to adopt this new standard. And I've seen reports show that it's still a mixed bag on whether or not companies will use the modified retrospective approach or the comparative approach. And it really depends, in my mind, a little bit more on what your future aspirations are, right? If you're going to stay a private company, you'll be okay. And if you're going to be a public company, then you might have to do more of this retrospective approach to get everything moved back into the proper periods. Here's a quick refresher on what a lease is under 842. It's expected that we're going to see over $3 trillion of lease liabilities with the corresponding right to use asset get recorded as a result of this. I haven't really looked or seen for any updated reports to see if that 3 trillion is still accurate, but that's what it was when we started putting these slides together. And lessees are going to be the ones that are really impacted by this. We've received a few questions on the lessor side, but I think that piece is really pretty simple. So if you've got questions relative to that, we can certainly talk with you about it as well, but we're not really going to cover that in any of our presentation notes here. And there's two concepts here that are really of importance, and they're highlighted on this slide. So contracts that a company enters into will need to be examined to determine if they are a lease or contain an embedded lease. And I know we've talked about embedded leases before. What we're practically seeing is the embedded lease concept really isn't impacting many of our clients outside of some specific industries, which I'll give you some examples of in a later slide here. And so a physical asset also has to be identified in the contract. And lessees will have to have the right to control the use of that underlying asset, with control being defined as being able to take substantially all of the economic benefits of the asset through the lease term, and also directing the use of the asset. So if both of those items are not met, then you don't have control and the contract is not considered a lease. And then also, a lessor can't substitute an asset. So think of like a situation where you're leasing a truck fleet or something like that. If the lessor can simply substitute a truck if one breaks down, then you may have some considerations there to consider. Okay, Joe, here you go.
Great, thanks, Frank. So here we just summarized the 6 steps to prepare for the adoption of the new standard on this slide. If you attended any of our previous webinars, you've heard us speak about these many times before, but if you're new to the webinar and you haven't really heard about these before, or maybe if you just need a refresher on these 6 steps here, we did include a link in the slide deck here to our blog, which will describe each of these in some more detail for you.
Okay, so let's get into our discussion of lease modifications. Lease modifications can take place throughout the life of the lease, and we're going to highlight how to account for those modifications. This is important because, you know, there's still activity in the marketplace that is showing that there are some modifications taking place, even though my opening comments said that it's less common right now. But absent the pandemic, modifications can happen for a variety of reasons. I was kind of focusing more those comments relative to the COVID modifications that we've seen, which have a little bit of a separate accounting for those. As you're going to see, technology is critical to all of this because it helps you run through these calculations and make it a lot more simple for you to figure it out. And that's going to significantly reduce the burden on you as you try to figure out these changes.
All right, great. Thanks, Frank. So historically, we can kind of think that accounting for lease modifications is somewhat an infrequent area that you've really had to address in practice. Kind of as Frank mentioned, the COVID-19 pandemic really upset that general rule, and with lease modifications, concessions, terminations becoming more frequent during the last 2 years. And really they were designed to offer some relief to lessees that were maybe experiencing some challenging economic conditions. And now that we're in 2022, the COVID ramifications have definitely softened, but we kind of take a step back, and it really highlighted that the last 2 years placed a spotlight on the necessity for entities to have the processes and systems in place to account for these modifications when they do occur or may occur, whether that's related to COVID or just general business practices. With these changes in the landscape and affecting how entities conduct businesses, along with a new standard coming out at the same time, a lot of private companies and nonprofits are just starting to ask the question, how do we account for a lease modification under ASC 842? So to start, if we take a little step back, a lease is a contract with specific performance obligations. Now, if circumstances or an agreement between the lessee and the lessor require modification, the first factor a lessee needs to consider is whether the lease contract already considers these changes or modifications in the lease itself. For example, if the original contract provides for relevant changes at hand, a modification accounting would not be applied. A good example of this is to think of an option to, but not an obligation to, expand square footage in your office space if it becomes available in the future.
Okay, before we hit our next slide, let's launch our first polling question, if you guys wouldn't mind. Okay, so here's polling question number 1. How would you rate your preparedness for adopting ASC 842? We've got well prepared, somewhat prepared, still gathering the facts, and not prepared at all. And we'll give that just a second. We've got about 59 participants, so I want to make sure everybody gets an opportunity to get their CPE credit. Just a couple more. And it looks like we're stalling out around 54. So let me end that and share the results with you. So, about 15% said well prepared. The lion's share, about 80% are in that somewhat prepared and still gathering facts, and about 10% are not prepared at all. So I don't think those results are really all that surprising based on what we've seen in our own practice and from the folks that we've talked to. So pretty consistent there.
Okay, thanks, Frank. So next what we're going to do is, what needs to be considered if a modification is not deemed to be a separate contract? Kevin, can you provide a little insight on that for us?
You bet, Joe. So your lease modification doesn't meet the criteria that you spoke of for a separate contract treatment. However, if your modification meets any of the 4 conditions that you see on this slide, whether it's a change to your ROU, maybe a reduction in square footage as we listed here, maybe your lease term changed, or what if it was partially or fully terminated? Obviously, that would be considered a big change. And the consideration has changed, reduced monthly rent, timing of payments, those sorts of things. If any of those occur, then you need to go back and reassess and remeasure all the elements of that lease as if it were a new lease. And important thing to remember here too is that a lessee must also consider any changes to the initial direct cost incurred to obtain that lease, or cost incurred for the modification, changes to lease incentives, or any other modification related payments using the same principles as if it were a new lease.
Great, thanks so much, Kevin. So what we're going to do now is we're going to talk about some of the effects and the changes that were explicitly related to COVID, and kind of repeating what Frank said. We're in middle of 2022. We don't have as much disruption related directly to COVID, but there is some specific language in the standard that we still wanted to present to you because it does paint a more complete picture of some of the options available to you out there. Okay, so here what really happened was, in response to a lot of lessees being unable to make payments according to their lease agreements, some lessors decided to offer lease concessions during the pandemic. Most commonly, we were seeing this in the form of some payment forgiveness, maybe some rent abatements or deferrals. And really what this was it was an effort for lessors to maintain a good business relationship and recoup any potential lost income that they may have lost if they didn't offer some of these concessions. Now, under the new standard, a lessee is required to account for these modifications as if it was a new lease under these modified terms. But as you can see here on this slide, the FASB did address some of these concerns related to implementation efforts, costs associated with the accounting for the new standard, all kind of on top of the direct impacts that some companies and entities were facing under the COVID-19 pandemic. So I know you're going to love this word here. If a lease modification did not result in a substantial increase, which is judgment, to the rights of the lessor or the obligation of the lessee, there is an election in the standard that allows the lessee to ignore the modification guidance and basically leave their lease as it was originally written. Now, since we're kind of a couple years past COVID-19, I think you would have a much harder burden of proof to pass that judgment of saying, this modification is solely related to COVID and nothing else, and I don't need to account for this modification. We're not saying that's not a possibility, but where we are today versus when this standard update kind of came out, you kind of have to take that with a grain of salt. So that's something to consider.
Yeah, thanks, Joe. Obviously, one of the things you're probably picking up here is that when you have a lease modification, there's going to be a lot of things to keep track of. And, LeaseCrunch can definitely assist with tracking, accounting for, and managing those lease modifications within the software. This is going to save you time and just reduce the concerns around all the tracking that goes on with modifications. Jess is going to show some of that when we go through the demo a little bit later.
Okay, so let's transition into an overview of the changes to financial statement presentation and related disclosures. I think we'll see a bunch of questions pop in relative to this. So, Joe, what are some of the changes lessees can expect to see on the face of their financial statements under 842?
Sure, Frank. Let's take a look here. So this slide has a really good high-level summary of some of the changes you're going to see here between the balance sheet and the income statement. You've probably heard this before, but the biggest change you're going to see on that balance sheet is that separate right-of-use asset for both financing and operating leases, as well as that corresponding lease liability for each. So kind of as we've mentioned before, old standard, all the capital leases, which are currently called financing leases, those are reported on the balance sheet, but all those operating leases didn't show up anywhere on your balance sheet. They were only disclosed in the footnotes. Biggest change for this new standard is bringing all those operating leases onto the balance sheet. So one thing I want to show here as well is your liability section is going to have both a current and a non-current portion as well for both the operating and the financing leases. One other thing we want to stress is these changes to the balance sheet presentation may have some effects on bank covenants. And the banks are aware of what's going on in the marketplace, and we do a lot of speaking engagements and collaboration with our bankers, but we don't know what's in everyone's bank agreements, and there might be some clauses in there that a covenant might get affected or out of compliance by bringing these assets onto the balance sheet. I've also seen in the marketplace that a lot of agreements do have a clause that might have a carve out that says for any new accounting pronouncements effective after the executed date of some type of agreement, those wouldn't affect covenants, but the devil is in the details. So really what I'm stressing here is just having a 15-minute call with your bank to discuss what these changes might look like could save you a lot of time in the future. So we always want to stress that. Then here on the income statement side, there's not as much of an impact really. What we want to kind of stress here is I think you're going to have a more challenging time tracking everything and getting it in the right buckets and places rather than really what the effects to the bottom line of a company might be. And really, one of the benefits in LeaseCrunch is doing all the tracking, all the journal entries, all the disclosures, and all the calculations for you. So that's kind of what I'm stressing here on this piece. Last thing we want to talk about here is what's going to happen on your cash flow statement, because there are going to be some changes there. And Frank, can you talk to the group about that for us?
Sure. So a few weeks back, I was doing a concurring review on a set of financials for a company that had already adopted. So that was really helpful to see kind of the full picture of all of this, right? So for the cash flow statement, you can see the different treatments between a financing lease versus an operating lease. And you can go back and look at some of our previous presentations for how to calculate the discount rate and what the impact is on the lease liability. But I like to keep it somewhat simple in my own mind. And when I think about the cash flow statement, I think about that section at the top where you see like depreciation and amortization. I call that the adjustment section. So you're going to have a piece there for the non-cash portion of the amortization of that lease liability. And then down in just your normal operating changes, you're going to see the changes there for the changes in that operating in the liability that we're going to record relative to this as well. And then down in the financing section is where you'd see the other piece. So it's kind of expect 3 line items, I guess, is what I would say if you've got all 3 of these type of situations. If you just have normal operating leases, it's going to be even simpler. And then for foreign currency presentation, that's really going to vary for the ROU asset compared to the lease liability as shown on this slide here. And LeaseCrunch does have the ability to factor in foreign currency into its calculations. I think Jess will touch briefly on that as part of her presentation.
Great, thanks, Frank. Next, what we're going to do is we're going to talk about, as Frank alluded to, maybe the meatiest part of this new standard is some of the accounting policy adoption elections and some of the disclosures you're going to have to consider. One of the key things we want to talk about here is the idea of judgment. There's going to be a lot of disclosures about any of the judgments used for calculating the discount rate, any practical expedients you've elected, measurement of the right of use asset, among some other items. Each accounting policy is going to have to be tailored a little bit to match the specifics of your company or organization. This isn't really a boilerplate paragraph that companies can copy and paste from other sets of financials and present the clear picture for your company or organization. And the great thing about LeaseCrunch is, which Jess can also show us later, is there is a wizard, a policy election template tool that can really assist you with some of the pertinent questions that you need to answer before you even draft some of these policies and disclosures. So it's a really helpful tool that we have there. Okay, so next year we're going to get into some of the footnote disclosure requirements. I've kind of tried to summarize them for you here on this slide here. And again, you can see this word popping up over and over. It's reasoning and judgment behind applying some of these requirements is a real important portion of these new disclosures.
Yeah, and I think, as you've said, Joe, this is really where LeaseCrunch can help with a lot of getting this prepared for you. This is really what I see as the challenging piece of all this.
Yep, exactly. Okay, we listed a few more of the disclosure requirements here on this slide. Some of the other things you need to consider here in your financial statement disclosures. Now, one thing to remember is in the footnotes, we'll need to segregate the disclosures for the operating and the financing leases separately. It can still be one note, so let's pretend it's note 10 in your financial statements. That will still be your lease commitment footnote, but there's going to be clear delineation between details for operating leases and details for financing leases. And again, LeaseCrunch, we're going to show you a quick example on to really how we can help assist with this potentially to kind of just remove some of the judgment, the burden, the time, the guessing, all those things can kind of be really reduced with the help of LeaseCrunch. So one thing we're going to do, we're going to go over some of our service offerings now briefly before we get to the demo.
So we've really tried to simplify things and our approach so that we can offer just about anything that, you know, a prospective client or an existing client might need. Kevin, can you walk us through the boxes that we've got here and maybe focus on the different types of assistance that we can provide?
Sure, Frank. So we've set up our offering to provide clients options across the services shown on the slide. We suspect, well, we know at this point, many companies, especially year one, are going to want more help here. So for them, we can outsource the entire effort. Others will have an implementation plan and the internal resources required to handle it. So maybe they just need a tool to help with the calculations, the footnote, and simplify the maintenance. We can provide that as well via the LeaseCrunch software. To help clients figure out where they are on this, it all starts with an assessment where we'll go through and help clients figure out their preparedness for the standard and what level of service they need. We have a nice checklist and guide that makes this assessment very effective and efficient.
And I think, you know, if I can look back over the clients that we've been involved with so far, at least in year one, they want a little more hand-holding and want someone to look over their shoulder a little bit more. But once they get into the software and start feeling comfortable with it, you know, then they're like, we've got it, we can handle it from here. And so we're happy to help however companies need support. So like I said, LeaseCrunch is a great tool, and you know we will continue to support it. So the one thing we will move to, if you engage us, is to on-demand support going forward. And I think, you know, I mentioned this earlier. I talk about where we thought the embedded lease issue would fall, and let me just mention that now. So for companies that may have an IT service contract, the thing you need to watch out for there is whether or not there's an underlying dedicated server that's embedded in the contract. And unless you're a fairly large company, I don't think you're going to have this issue. The piece where I get a little bit concerned is for those of you that are perhaps using contract manufacturing. So I think about our food and beverage practice where, you know, when they're young companies before they really get established, they may have a contract manufacturer doing the work for them. And if they have a piece of machinery there that's dedicated to you and you're taking all of the output from it, then you may need to consider whether or not that's a lease. And what I think about there is, think about if you have a food pack, or a food product that has some specific packaging to it and they have to buy a particular piece of equipment to do it, or if there's something in the manufacturing process that requires a specialized piece of machinery, that's what I would look for there. Once again, I don't think there's going to be a lot of that, but it's something to think about. And then also in our construction practice, whether or not we've got dedicated assets and some service agreements, we'd have to examine that and think about what needs to be analyzed there. So before we head into the LeaseCrunch demo, it's time for polling question number 2. So Kaylin, if you could put that up, please. Okay, so which are you planning to use to track your leases? Account for new requirements under 842 and prepare required journal entries. Excel, automated solution, both undecided. So it's interesting. I'm seeing a lot more folks hitting the Excel option here. I'll share this in just a second. We've got about almost up to 50. Give it just another second or so. That, and I'm going to go ahead and end it and share the results here. So about 40% of you said Excel, and that's, to be honest with you, I think that's higher than we've had on any other call. A lower percentage are looking at an automated solution, and about a third of you are undecided. So that is a little bit surprising to me, and my advice, take it or leave it, is you really need to think about an automated solution, because those of you doing this in Excel, it's going to take you longer to do it. It's going to take your auditors longer to audit it. And when you see all the stuff you need to accumulate for the footnote, I think you may think a little differently, but obviously everyone's going to make their own decision there. So let's move into the LeaseCrunch demo. Jess, I'm going to stop sharing and let you take over.
All right, thanks, Frank. Good afternoon, good morning. So as we get started, the team today has spent a lot of time talking about revisions and footnotes. So before we lean into the LeaseCrunch system as it's related to revisions, let's first walk through adding a lease. Actually, before I even do that, I want to talk about that policy election template we've talked about. I think Joe brought up that there is quite a bit of judgment that needs to be made as it's related to getting started with applying the standard to our leases. So here in LeaseCrunch, under administration and then under policies, you'll be able to download our lease accounting policy template, which I've already got pulled up for us here today. The great thing about this template is that it's a Word file. So your organization will be able to walk through the particular policies, make the decisions that are best for your organization. Here at LeaseCrunch, as you can imagine, we've spent a long time studying the standard and studying organizations that have already implemented. And we've made some presumptions about how most people will implement the standard. So we've kind of pre-selected some things here. We've also offered advantages and disadvantages toward applying the standard to these leases and what makes the most sense. So as Joe mentioned, there's a lot of judgment. I think judgment was the first thing I learned when I joined LeaseCrunch last year, that if you're going to know anything about the new lease accounting standard, it's that you're going to have to make a lot of decisions as it's related to your organization. So know that we've got a template available to you. As we go back into our system, let's talk through adding a lease. I'm going to walk through the lease process, and then we'll talk about revising that lease. So as an example here today, I'm going to enter just a reporting entity, and then I'm going to enter a lease name. I think we talked a fair amount about office space today. So let's take a look at entering in a lease for office space. Here in LeaseCrunch, you can add as many or as few details as you'd like. I think there's only 12 required fields. If there's some additional information you'd like to include about your leases, we have plenty of fields available and custom fields as well. So I'm going to walk through adding my specific lease. My asset type in this case is going to be office space. Then I'm going to select a location and lessor. And as you might note, these are optional fields. Here in LeaseCrunch, if I don't care to manage the location or lessor for my lease, I certainly do not have to. Next up, let's talk about some wizards. Here in LeaseCrunch, our lease term wizard is going to help us walk through our early termination and renewal options. So for example, today, let's say that our lease began on May 1st and it was a 60-month lease. When I enter that data here, the system is going to fill in my end date for me. So really clever that I don't have to do that hard math. For those of you who know me, I worked in real estate for 14 years prior to joining LeaseCrunch, and many of those leases have only a term or only an end date, not always both. On the second step in our lease term wizard, you're going to see the question about, are you reasonably certain to bypass an early termination option? Again, reasonably certain. I think we talked about that earlier today. That's a high bar. So we want to really be thinking about the economic incentive as it's related to this lease, not just a gut check. Some legit, information about this, not just, how the wind is blowing or how I'm feeling about it today. The next step in the wizard is going to be our reasonably certain exercise, our termination option, or I'm sorry, renewal options. If I had hit yes here, the next step will be asking us for a new end date. So I'm going to select an end date out a little while, a couple of years. Let's say we're going to go here and see what that gets us. When I click finish on my wizard, you'll see that my start date, end date, and term are filled in for me. And I've got my ROU asset life as well. That's the last of the required fields on this particular screen. But you'll also see an opportunity to add comments about the lease. A lot of our users are adding things like renewal terms here. And then you're also going to see things like custom fields. So if there's something about your leases that's beneficial to track, you can certainly add custom fields here in LeaseCrunch. When I hit next, I'm going to save our progress and move us forward to step 2. Step 2 is going to be where we're going to enter things like lease payments and determine our lease classification. The first thing we're going to do is enter our discount rate. For many organizations, we might be using that risk-free rate. And if you are, we also have tooltips. Anytime you see those blue question marks, our tooltips will bring you to topic-specific help within the app. So some really great information there. The next thing I'll do is enter my payment streams. Let's say, for example, this particular lease is going to have just a few payment streams, but they go out quite a few years. So I can adjust this for any particular lease information that I have. In fact, I was just looking at a lease for a client of ours that is a 99-year ground lease, and the landlord who wrote that lease changed the lease payments every other year. So as you can imagine, when you're looking at payments on this particular screen, it's quite a long list. So the next wizard we're going to talk about is our classification wizard. As we talked about earlier today, our classification of leases under ASC 842 is going to be finance and operating leases. And our classification wizard is going to walk us through determining exactly what our classification is. When I click finish on my wizard, we're going to see that I've correctly classified my lease as a finance lease based on how I've answered the classification wizard. And then next up, we're going to see our GL accounts. Our GL accounts are pre-filled for us from our administration menu. That's part of our initial setup. Those can be changed at any point in time. And we can also include cost center allocations here as well. So for those of you who might be thinking, well, I need to allocate my expenses to certain divisions in my organization, we can fully support that as well. Something we didn't talk about a whole lot earlier today is our variable expenses and non-lease payments. For those of you who have those types of expenses, we'll be able to add those here. And entering our payment streams on this screen is the same as we had seen before on step 2. And then finally, we're going to talk about attachments. So the great thing about LeaseCrunch is that I've got unlimited file storage. I'll be able to add my lease documents here, and then everything lives right among your lease accounting information. So you've got your lease documents, your policy elections, etc. So that's adding a lease. Next, let's take a second and talk about that revision.
Hey, so Jeff, before you get to that, can I interrupt for just 1 second?
Yeah.
On the heels of what you just talked about, can you talk about how a company could then use the information here to interact with their auditor?
Absolutely.
I think that's it's one of those intangibles that we don't necessarily think about a lot, but just like any other cloud-based software that a company uses, the ability to give auditors access and for them to get that information is hugely important. And I also want to make sure we mention that LeaseCrunch does have a SOC 1 report. So I believe it's SOC 1 and not SOC 2, right, Jess?
We have both. We have a SOC 2 type 2 and a SOC 1 type 2.
Okay, great.
So the great thing about LeaseCrunch is we primarily work with CPA firms, and CPA firms are able to invite companies to use the software, which automatically gives that CPA firm access. And let's say, for example, you wanted to control that access. So maybe I want to have Frank and the team only see access to my account on certain times of the year, certain days of the week. I can fully control access just by clicking or unclicking this box. So that really gives you full control over the system. And like Frank mentioned earlier, this is a cloud-based system. It's hosted on Microsoft Azure. We have a SOC 1 and a SOC 2. So fully secure, and Microsoft, if you're familiar with Microsoft, they only have about one outage a year, and it was last week. So as we were talking about, let's talk about that revision. So I'm going to click the blue pencil here, and that's going to be our edit button. When I click edit, this is where I can change my lease. If I have any adjustments to make on this particular lease, I'll edit those here. But let's say, for example, I do have a revision. In the upper right-hand corner, I'm going to select Add Revision. This is where we're going to revise this particular lease. So let's say that this lease is changing as of July 1st. This revision workflow is going to tell us what exactly happens to our lease. We're going to see our revision begins on July 1st, and our previous version of this lease is going to be frozen as of 6/30, so the last of the prior month. On step 2, we can add comments about this revision. Recently, we've started talking about this field as, what do I want to know about this revision at the end of the year, or when I'm talking to my auditors about it? Those are the kind of comments you'd like to include here. And then finally, on step 3 of our add revision workflow, you're going to see what happens next. When I click finish here, we're going to see that some data is removed and will need to be updated. Some data is brought forward and not editable, and other information is just going to be brought forward, and we can make those adjustments. When I click finish on this add revision workflow, you're going to see that my screen changes in a few ways. The first is here at the top, I can always toggle back and forth to those original versions. As a user of software and a former property management professional, I find this extremely helpful because I don't have to hunt and peck for my original lease. I can just toggle back to it if I need to. Next up, you'll see a summary of that revision information, as well as the highlighted tabs that need our attention. We know that we've started our revision, but let's say we need to add our term. Once we do so, we can either do it here in the fields or walk back through the wizard. We'll save our changes and navigate back through the rest of the tabs that need our attention. So payment information, GL accounts, etc. I know we're running up on our time, so I do want to take a minute to talk about reports. Some of you may have seen our system in the past and have seen some of the reports available to you. Here in LeaseCrunch, we have a journal entry, an amortization schedule, and a footnote. We talked a lot here today about what that footnote looks like under the new standard. And yes, you might be able to do that in Excel, but don't forget, the footnote now contains something like 16 more calculations than it had under 840. So tracking those might be a little bit more difficult than we're taking into consideration. So I'm running my reports here, and then in a second, I'm going to open them. The first one I'm going to take a look at is my journal entry. So this journal entry is going to be all of the leases that I had here in LeaseCrunch summarized into one entry. I've got quite a lot here because I have multiple cost centers. What you'll see first is our initial journal entry to record the ROU asset and lease liability for those finance leases. Then I'm going to see my amortizations and interest expense and any other variable type expenses as well. We mentioned earlier that these are also going to be separated by operating leases and finance leases. So you'll see your operating lease journal entries coming up next. I ran this report for an entire year today, so we're going to see all of that information here on one report. And as I scroll down, you'll see subsequent months. Next up, let's take a look at that amortization schedule. Give me 1 second. That amortization schedule is going to be the horizontal view of those journal entries. So same information here. We can also use this report to tie out our balances, a handy tool for that month-end or year-end reconciliation to make sure that your lease accounting system is tying out to your general ledger. And then finally, the footnote that we discussed earlier. This is what our footnote is going to look like. We have here at the top our annual lease expense information. That's going to include your finance lease expense, which is the amortization and the interest. You'll see your operating lease expense and any variable lease expenses here. You're also going to see that other information, and this is really a big one. We've got our operating cash flows for finance leases, financing cash flows for finance leases, and our operating cash flows from operating leases. The system does the legwork for you here. And then we also will see our ROU assets obtained in exchange for new lease liabilities and our weighted averages. So I don't know about you guys, but I quit calculating weighted average when I got done with college about only a couple years ago. But I don't ever want to do that again. And then finally, maturity analysis, remembering that all of these things must be separated by finance and operating leases. Another thing that I want to just talk about that Frank mentioned earlier was the opportunity for LeaseCrunch to handle things like currency. So as you can see here, we've got a couple of other tabs that talk about our foreign currency translations, and we can fully support that as well. Right. Frank, anything else you'd like me to cover today?
No, I think that's it. I think you hit all the high notes for us there, so I appreciate you doing that. Why don't we switch back, and then I will share my screen and see if I get this right this time. Hopefully you're now seeing something that says LeaseCrunch demo. We're going to move on to our next polling question. And why don't you pop that up, Kaylin? Okay, so do you anticipate needing assistance with drafting the required footnotes and disclosures under ASC 842? And kind of in line with the previous slide relative to whether or not you were going to need a tool or not, I think we're seeing some similar type responses here. Give it just a second for a few more people to pop in, because I want to make sure everybody that needs CPE credit is going to get it. So we're about 30% yes, about 40% no, and about 30% undecided. So I'm going to end that and go ahead and share the results there real quick. So very consistent with the previous questions. Okay, let's continue on.
Great, thanks, Frank. So in addition to all the outstanding features and functions that Jess has just demoed for us, another key factor that makes LeaseCrunch so attractive is its pricing. You know, we're talking around $15 per lease per month. Of course, that depends on the number of leases, but you know, that can pretty much fit any budget, and it's appropriate whether you're accounting for a single lease or hundreds. And you know, this full featured software that we've seen here, it's easy to learn and use. And just like I mentioned earlier when referring to our service offerings, we'll meet you where you're at with regards to your specific needs. You know, whether you want just guided help as you go through the wizards so you can self-implement, or you want us to take over the entire effort on your behalf. It's a great option. Hope you'll consider it.
Okay, so here's a brief recap of what we have talked about today. And once again, if you have questions, please start putting them into the Q&A, and we will try to address those as we wrap up here. But you know, the implementation date is here for the standard. We suggest trying to get out in front of it as much as possible before we hit the year end. But like I said, what we're seeing in the tea leaves here is most people are kind of putting this off until a little bit later in the year right now. It's certainly something that we can help you with, depending on where you're at. Like Kevin said, we'll meet you there, all the way from, you know, hey, just providing a software application for you to full implementation. We have a landing page on our SSF page, and that link is here on the slide. So when you get the slides later, you'll be able to go right to it. And there's a bunch of information there that I think you'll find useful. And then you can also use that to sign up for, you know, one of our 15-minute consultations where you'll get a chance to talk with myself or Kevin or somebody else from the team about your particular situation. And then we can talk about how we may help, or at least give you some feedback on what you communicate to us. So we're happy to do that. Here's what we've got lined up for our next webinar, really to talk about the post ASC 842 adoption best practices that we've seen out there. That kind of will conclude things for the year in terms of the topics that we've covered. And you should look for that coming out over the next couple of months. If there are things that you'd like to add or additional questions that you have that you think might make sense for a webinar, you can chat them in today, or you can reach out to us after this, and we would be happy to address those with you. And so with that, let's take a look at the questions that we have. We're at just about the 49 to 50 minute mark, and we need to make sure that we go all the way to 55 minutes in order to make sure we get credit for this for CPE purposes. So let's see what's in the Q&A. So Anthony had a couple of questions there. Joe, you want to grab that first one?
Yeah, so I took a quick look at that. On one of the slides, the balance sheet language was a little bit more akin to some of the cash flows disclosures. So we'll make a slight edit to that one sentence or two sentences on that slide for the deck before we send it out to everybody. So our talking points about the balance sheet changes match that slide there. So that's one slight edit we'll make for you there. And the second one, yep, slides will be sent to all the participants so you can have access to this slide deck along with links to our blog that was referenced in that as well. So, yep.
And then I think relative to slides, Dee, you can chat me whether I'm wrong on this, but the slides from previous webinars should be available too. I know we've got the presentations that are out there that are there, but like Anthony said, sometimes having those slides to be able to go back and refer to are quite helpful. So if you need anything from a prior webinar, let us know, and we can typically drum that information up too. So that answers the first two, and then we've got a question there. What date for the RFR should be used when using it? Risk-free rate. So Joe, you want to tackle that one too?
Yep, absolutely. So really the way to look at this is the standard is effective for calendar year companies as of January 1st, 2022. So that is the implementation date, and that is the date you would use for the risk-free rate for all of your leases that are in existence as of the adoption date. Now, let's say you enter into a new lease on July 1st of 2022, then you're going to use the risk-free rate as of July 1st for that lease. So really the easiest way to think of it is any lease existing is the date of my adoption, January 1. Any new lease or any modification that happens to a current lease, that's when you're going to reassess that rate as of that modification date or that new lease date.
And I think the reason for that question, you know, in my mind, if I hadn't gone and done all my homework yet and been prepared, you know, if we had a lease that was entered into like 3 years ago, people may be thinking that they need to go back and look up the risk-free rate as of 3 years ago when they entered into the lease, but that's not the way this actually works. It's that implementation date, right, Joe, that we need to be concerned about. And so that's why
Exactly.
your comments relative to that are spot on. And then also as it relates to the modifications, that's going to be a current item to look at. So that's good. And then we had a question about the retrospective versus comparative adoption. You want to hit on that real quick?
Yep, absolutely. So the easiest way to think about it is, you know, comparative, it kind of is what it is. Comparative means you're going to have to go back a whole extra year. And if you're doing, let's say, your 2021 and your 2022 financial statements together in one audit report, and you elect the comparative method, you would have to go all the way back to January 1, 2021 and do this whole accounting rigmarole for the whole 2 years under the new standard for your 2022 reporting. Then if you take the retrospective option, all you have to do is update and adopt as of Jan 1, 2022. So if you're presenting comparative financials, you don't have to do anything to your previously issued financials in 2021. Only your current period financials would have to be adjusted to meet the new standard.
And I think what we're seeing, practically speaking, is if a company has a desire to go public or they need, you know, 100% accurate financials going back where everything is fully loaded, then they may use that comparative approach. But for the lion's share of the private companies and the not-for-profits that we deal with, that modified approach is most likely going to be a lot less time and a lot easier to implement. And I would recommend that unless you've got some particular facts and circumstances where maybe you need to get something out to investors, or like I said, if you're planning on going public at some point in the future and you need to be able to look back for 5 years at some point in that offering document, then you'd want to use that other approach. But other than that, I just don't see a reason to go ahead and do that. Okay, so it looks like we are out of questions. I want to thank everybody for participating today. Be on the lookout for the additional emails that will be coming for our last webinar in this series, which is really to talk about the post-implementation piece of all of this, which is also quite important. And we'll have some tips and tricks for you there as well. And like I said earlier on, please go and take a look at that YouTube channel. And also, we're going to give you the link to sign up for that free 15-minute consultation relative to this. So please take us up on that. We'd be happy to help you with whatever you need assistance with. And with that, I think we are ready to conclude for today. So thank you, everyone, for joining. And we'll see you in another month or two when we do our final webinar in this series. Thanks a lot.